All right, my friends. Welcome to another Viking webinar. We're very excited to share our latest deal to our investors. So, Judah, as people are coming into the chat room, what's going on in your world?
Yeah, listen, as you always tell people, we look at 1,000+ deals a year. So we are really busy underwriting. What's super exciting for us is when all that effort leads to an opportunity like this one. So, we've already started underwriting the next wave of properties coming our way, but, getting a good deal like Park 33 that we're going to discuss shortly definitely re-energizes the whole team here to look for that next one.
Yeah. There's a period of time where it didn't look as robust as it normally does for a commercial multifamily. And as interest rates have started to stabilize, as sellers are starting to realize, what their properties are worth, and buyers are getting more aggressive again, and things are starting to make sense, especially this deal with positive leverage, I see transactions picking up by the second half of the year. And Ravi, you've been out there in this robust market, especially the South Bend MSA. Why is that sort of attractive to us as Viking, you think?
Yeah, so I'll speak to that, but I also just comment on what Judah said. As we've been underwriting more and more deals, we've noticed that our strike and what the seller's expectations have been off about 30%. And then as time has gone by, now this was several months ago, and as time has gone by, our strike and their expectations have become more aligned. And in this particular deal, they exactly aligned. And I'm very excited to talk about this deal with all of you. As far as South Bend as a submarket, I love South Bend. We have a deal there, Elevate at the Main, which is a phenomenal deal. It's doing very well. And this deal in Park 33 is a perfect sister property to that one.
Guys, fantastic. And looks like I'm looking in the chat box now. We're getting people coming in. If you're, wherever you are located, please put in the chat box. And so we can just reach out to you and greet you because, again, we have a national investor base for Viking Capital. And I'm already starting to see some people populating the chat box. I have people from Virginia, we got Florida, we got New York City, we got California, we got Texas. So this is awesome. Welcome, everyone. And I want to say hello to our current investors. Thank you again for your trust and support. And I want to welcome the new Viking investors into the fold. And congratulations on taking the choice to take back control of your own financial destiny and learn about different asset classes and learning to invest and create that financial future that you want. So with that said, guys, let's start with this webinar and really help share some of the newest ideas and information on Park 33. All right, let me just get to the front of the presentation. And as we get there, one of the coolest things we found out is there's so much more activity that we're starting to see now in a lot of the markets. As there's certain operators that really perform well during this time of the economic cycle, and there's other operators who actually are not prepared. And Judah, I think we've discussed this, where because we buy right, we have cash reserves, we know how to execute our business plans very rapidly, even though there's these rates fluctuations and interest rates that are, floating rates that have hit certain ceilings. It's interesting that some of the operators are really doing quite well and others are sort of struggling during this time.
Yeah, groups that took on the more high-risk opportunities, maybe ground-up opportunities or near ground-up opportunities that didn't execute and they're stuck with, land and development. Or people that bought stabilized opportunities like we do, but really, based on a value strategy of simple appreciation, and they found themselves, in some tough management situations. Yeah, there's certainly some groups are struggling, but thankfully, when you're buying stabilized properties, when you are an owner and operator first and foremost, and you can execute on a business plan, then deals like this, deals that we bought recently, all continue to perform and allow us to really create that value.
So with that transition, let's go ahead and get the webinar started. So my name is Vikram Raya. I'm CEO and co-founder of Viking Capital, along with my good friend and co-founder Ravi Gupta, who's our COO. And Judah Fold is our Vice President of Acquisitions, and we are here to present this deal. But before we do that, just a little bit about Viking Capital. We're a company that was formed in 2015 as an investment firm to help high-income professionals really achieve financial freedom, time freedom, and take back control of their financial destiny instead of just hoping that a financial advisor can help allocate their funds. And so one of the asset classes we've specialized in is multifamily. We think it is not a luxury asset, but this is a necessity that the whole country needs. There will always be need for rentership, and we want to provide quality, high tier housing in multiple markets for people and for communities. And we've been recognized by several organizations, as you can see listed below. One of the coolest things about Viking is we really have a sort of a 5-pronged approach to helping our investors. We really believe in helping them achieve cash flow, really be careful and opportunistic with the tax strategies, help them diversify among various types of assets within the multifamily space. They can take advantage of the appreciation as well as the equity buildup. And our investment thesis is really finding these tier 1 cities such as Atlanta, Dallas, Austin, Washington, D.C., that are really poised for the next level of growth, and finding pockets within those cities where there's value add opportunities. We've also started to look into secondary and tertiary markets and finding sort of the best properties, if you will, the diamonds in the rough of those properties, where we're able to do a very strategic value add and be sort of the kings of those markets. And I think we've been able to balance both strategies quite well. I want to introduce you to our team. There's no way we could have got to this level of sort of trajectory and progress without such a amazing, talented team. And so Ravi and I really am thankful and grateful for such a diverse skill set that we have among our team members. We have, as I mentioned, Judah, our Vice President of Acquisitions. We have operations in Amanda. Art is our Director of Finance. We have an asset manager. We have a whole investor relations team whom you'll meet. If you've already invested with us, you've already interacted with them, and some new members of our team, such as Ashley, who's been our marketing manager. And really, this allows us to provide best-in-class service and white glove experience, along with the institutional capabilities to our investors. We've been very busy over the last couple of years acquiring assets. And so we are at close to 4,800 units of acquisitions we've done so far, which is over $715 million of real estate we've purchased. And now we're going to move on to Park 33. This is our 188-unit premier apartment community that we're acquiring in the South Bend MSA. The reason why we love this asset is because, one, it is a newer quality asset. And so, Judah, I think you've mentioned many times during recessions and during downturns that people have the flight to quality. Could you explain to our investors what that means?
Yeah, absolutely. I mean, the theory of flight to quality is really premised on the fact that, whereas in the last couple of years, rents have really just gone up, and you've been able to just increase rents and tenants can do anything about it. When things shift a little bit, you see that price allocation, the pricing power shift to the tenant. And when that is the case, the tenants now have their rent dollars. They can choose how to allocate and where to spend it. The theory is, and it's proven true in many markets and in our own properties, that the tenants will choose to spend their rental dollars on the newer assets, the nicer assets, the bigger floor plans, to get more bang for their buck. I mean, it's really, when it comes down to it, it's something pretty simple, and that most people kind of get on the kind of just intuitive. So this asset, like on some of our recent purchases, fits that bill. 2018 build, 1,178 average square footage per unit, and just a best-in-class asset when it comes to amenities, when it comes to the curb appeal and the quality of the amenities, really, really top notch.
So within this MSA of the submarket that we're in, which is Goshen, there is not much A-class product. And so there is usually a waiting list for these kind of things. And Ravi, our CEO, was down on this property already during due diligence, and he came back with a glowing report of this asset.
Yes. As Vic mentioned, last week I traveled to Goshen. It's a beautiful, quaint little city, one of the suburbs or in the South Bend MSA rather. And I was able to speak to some locals and people familiar with the area, people that have grown up in Goshen. And a couple of them expressed to me that they tried to rent at Park 33 because, as Vic mentioned, it is indeed the only Class A asset in that area. And there was a long wait list. They weren't able to get in, and many people are trying to get in because a lot of people have to travel from distances to get to Goshen to work. And that is one of the few places they can live. Along with that, there's another construction project that's coming up, same architect, same type of design, but we're going to talk a little bit more about this later, but it's only 60 units as opposed to ours, which is 188. The rents are higher, and it also is in a much worse location than this particular asset is. So what I noticed just being there was how well this asset looked, how well it was maintained, the desirability, the drive to live in this area. It was very impressive.
Fantastic. So guys, let's get into the top 5 reasons why we love this deal. So I think my number one is I love the interest rate. In this economic uncertainty, in this kind of climate where interest rates are literally hiking up every month, it gives pause for many buyers to get into institutional multifamily real estate. However, we've been able to secure and assume a fixed 3% interest rate on this investment. So that is very exciting to me. Judah, can you comment on the Class A aspect of the deal?
Yeah, absolutely. This is a Class A, core plus quality deal, even though the returns are more value-added returns. And what we consider that as to be a risk-adjusted, win-win, right? You have the same high reward profile of the value-added deal that our investors have become accustomed to, but a lower risk profile. It's a newer property, 2018 build, top level finishes, and it's cash flowing day one. And the value-add strategies that we have, which generate revenue, phase 1, which is a lion's share of the value add, especially early on, there's no expense involved. It's purely revenue generating. As we'll get into shortly, it's services already been providing on site that tenants simply aren't paying for, even though they should be and they expect to be. So it's a lower risk way to add value and increase, the Viking contribution to the value of the property.
One of the things we've noticed is this has had a strong occupancy since its inception. This was built in 2018. And so since that time, historically, rent rolls have shown between a 95 to a 98% occupancy, which is very robust for this area. And even in this kind of recessionary environment, we're having a 96% occupancy along with a wait list. The fourth point that I really want to focus on is we have strong cash flow day one. I know many investors are looking for cash flow. And so when we're selecting the next property to present to our investors, that was one of our criteria. We wanted a cash flowing day one property versus hoping and waiting for cash flow to happen in the future. And then finally, our track record in Indiana is already established. We've purchased a 400-unit apartment complex 24 months ago, and we've already turned it around with a strong value add program. And we'll show you the increased value of that asset in a moment. But that gives us a leg into this submarket, number one. Number two, we already have our property management company managing our asset there. So for them to take this asset on is just providing economies of scale and efficiency. And then finally, upon exit, there is a strategy here for us to combine both of these assets and sell to a top tier institution.
Yeah, I really like these top 5 reasons, this slide and the overview, because those of you that are busy and then have to move on, I mean, this is a really good summary of why we like the deal. But I just want to add to this. Vic mentioned the interest rate. The interest rate is phenomenal here because it's a fixed interest rate. There's 7 years out of a 10-year term remaining. It's 3%. When we get a supplemental on top of it, it's still below 4% interest rate. And it's what we call a positive leveraged loan. The current cap rate on this deal is 6%. Our interest rate is below that at 4%. So, as Vic mentioned, day one out of the gates, we're cash flowing. And this type of deal, we have not seen since 2015 or maybe 2014, 2015. And now as this market cycle is coming around, we're starting to see more of this. So this is really exciting.
And I really want to hit the key points here as we move on to the remaining part of the presentation for those of you who are on a tight time window. 188 unit property located really in this South Bend MSA. It is located essentially 2 hours from Chicago, 2 hours from Indianapolis. It is large square footage, close to 1,200 square feet. There's stainless steel appliances, full-size washer and dryers, granite countertops. There's actually garages, which is unheard of for many apartment complexes. There's actually garages for certain select units, which they have to pay a premium for. Peloton bikes, a dog park, a fitness center. So no one can touch us in terms of amenities. And that's why we get the best tenant profile there. Built in 2018. And our goal is to do a two-pronged value add strategy. Phase one is the operational value add, which does not take any capital expenditure out of our pocket. We're able to do that just with the way we operate the property. And so we'll do that in the first 24 months. In the second 24 months, we plan to do a phase two, which is a light value add tech package. As was mentioned, the interest rate is a fixed interest rate, which is very hard to come by nowadays. It is a Freddie Mac agency loan, which is super safe. It is a 3.08% interest rate, which is highly attractive. And there's interest only through May 2025, allowing us to have positive leverage and strong cash flow from day one. Now, Judah, please go through some of the offering summaries and please maybe highlight maybe the cap rate and the expense ratios as well as the DSCR.
Yeah, absolutely. So the expense ratio here, which is the ratio of the operational expenses compared to the revenue, is 45%. Now, that's not atrocious, and I'm not surprised. The seller here is taking good care of the property, and they've proven they're adept as an operator. However, it's a little higher than we see on our other properties and our other property in the market as well, simply because the revenue is lower than it should be. Right? They're providing services with an expense cost that we'll mention shortly. They're providing utilities, they're providing cable and internet for free, they're offering a valet trash, a premium service for free, and all that without charging any revenue. So, that 45% expense ratio, given their Class A nature and everything else in the property, is one of the things that pointed to us that there was a revenue opportunity here. Now, additionally, the DSCR here, the debt service coverage ratio, a year one of 2.25% is very high. That means there's more than double the required debt service payment coming in revenue to cover debt service the first year. Average over life of the deal is still over 2%. So again, when I mentioned lower risk, this is another way to view it. Just simply the revenue is well outpacing any sort of loan payments that'll be required on a yearly basis.
So some of the investment highlights here, we'll go through it. I'll go through the asset one, and then Judah will tackle financial value add and economies of scale. So the asset is a 9-foot ceilings. It's really low density, which is very attractive. 14 acres, 2018 construction. It's a reputable builder. There's 21 garages, which are highly sought after. Amenities include pool, fitness area, grilling. Very well maintained asset, and a large square footage overall of the construction.
Yeah, and to briefly hit on kind of the value add opportunity here. So in this market, there are expectations, like in any market, what tenants have to pay for. Obviously, rent is the main one. But in most of our markets that we operate in, tenants pay for their own utilities. Tenants, if there's a premium service like valet trash, they pay for that. And additionally, that's all kind of in our phase one level. And then there's the actual phase two, which I get to in a moment, which is the opportunity to really renovate the units for an entirely new level of rent. Here, tenants have had utilities included in their, for free, paid for by the landlord for years. Only in the last few months has seller actually implemented the system called RUBS, where tenants pay for their own utilities. So number one, we're going to finish that off and continue it to make sure that we're getting our utilities paid for by the tenants. Secondly, the property's been paying for cable and internet service for the tenants. Again, the standard in the market is that tenants pay for their own cable. This is a service the property has been providing for free for who knows how long. We will phase in that tenants pay for their own tenant cable. And finally, there's premium service and value trash in the property the tenants are not paying for. When you put all three of those together, you're talking about well over $100 in additional revenue per unit on a monthly basis, which again, the expectation by the tenants themselves is that they should be paying for this. They just haven't had to so far. So that's kind of a low-hanging fruit. As Vic mentioned earlier, there's no capital expenditure needed. We're not spending any money that's not already being spent in order to capture that revenue. Secondly, as we get on in our life cycle of our business plan, we then plan on taking the units that are 2018 built, which means 2016 permitted and 2014 designed, and bringing them, now they're 8 to 9 years dated, bringing them up to speed. What that means for these units is adding in a tech package with smart thermostats. It means upgrading the kitchen with a backsplash, new lighting fixtures, relatively minor improvements that when you put throughout the unit will really bring it up to the next level and allow us to kind of earn the next level of rent payments.
And it sounds like there's a lot of leasing momentum. Can you speak on that?
Yeah, I think as Robbie mentioned earlier, there's actually a waiting list on site right now to get onto the property. When buying a property, I love to see a waiting list. When operating a property, I don't want to see a waiting list. Because when you have a waiting list on site, it means that your supply and demand is off. You're not charging the market clearing pricing for rents. Here, they've always had it to 96, 98% occupied, above market occupancy. And that all speaks to the main thing, which is that rents on site are below market. So with that leasing velocity, with the wait list already in place, there is ample opportunity for us to find the market clearing price, find where that supply and demand meet, and that's where we can really optimize operations at the property.
So that brings us to now how the investors get to participate in this project. So we have a 3-tiered return option that is classic for Viking. So if you've been invested in our previous projects, you're familiar with our Class A, B, and Reserve. And what it really is it allows investors to choose, what's more important to them. Is it cash flow? Is it back-end profit? Is it total splits? And we've created an investor class for each one of those optionalities. So Class A is really for those of you who want to prioritize cash flow. For many people who are maybe later in their investment game, their goal is just that strong cash flow. So this is you're at the top of the capital stack and you get a 9% preferred return. The Class B is a 7% preferred return. You're someone who is interested in both cash flow, but you also want to have the participation of the profit upon sale, and that's a 70-30 split. And the minimums for Class A and B are 50,000. Then we have introduced a reserve class. The reserve class is for those investors who want to commit at a higher level. And the minimum investment for that is 500,000. Normally, this was $1 million minimum investment. We've lowered it because there's been so much demand for reserve class. We wanted to help create more allocations for those investors. And really, it is the best possible return profile we are able to service to our investors, an 8% preferred return with an 80-20 split. So what does that look like in the actual offering? Well, our capital stack is really the reserve, the Class B, the Class A, as well as the Viking capital investment into the deal. And that's on top of the senior debt, which is going to be that Freddie Mac debt with the supplemental loan of $23 million. So the purchase price is $33.25 million. And we're bringing in about $23 million of debt and $15 million of equity. What that looks like for our individual investment classes is a Class A hits about a 1.45 equity multiple. A Class B, the range is about 1.6 to 1.8x equity multiple, and the reserve class is a 1.8 to 2x equity multiple. Right now, we are positioning this for a 5-year hold. Obviously, if there's opportunity to sell earlier, we will explore that. But our goal is to maximize our investor returns.
Just a quick point regarding the purchase price of this property. We offered, as Vic mentioned, $33.25 million. We actually weren't the highest purchase price on this deal. There were other groups that offered more, but because of our experience, because of our history, because the seller knew that we could execute and we have an asset nearby, they awarded us this deal at a lower purchase price. So, we're really getting it at a low cost basis, and we're cash flowing very well from the start because of that.
And for our investors, as they invest into these projects, we want to sort of map out what that roadmap looks like, or in terms of cash flow. So we're projecting for our Class A is going to be a straight 9 across. For our Class B, we're starting off at a 5% cash flow, and we're building steadily to a 7% cash flow. So that allows our investors to really escalate their cash flow over the time as we implement our business plan. And you can see here an investment of $100,000 at the beginning of the investment yields $170,000 at the end of investment, including the return of principal. For our reserve class investors, a $500,000 investment at the beginning yields a $950,000 return at the end, including the $500K return of principal. So many times investors, have different ideas of where we would exit the property. And so we've built something called a sensitivity analysis. It essentially allows investors to choose what they feel the exit environment will look like in the next 3 to 5 years. And so we've been conservative, and we're buying it essentially at a 6 cap. So selling it at a similar cap would yield us a 1.76x multiple and a 15% average annual return with a close to a 14% IRR. This, we believe, is probably on a conservative side. We really do think that at this level and this scope of a property would probably get close to a 5.5 cap on exit, and we think these are where sensitivities may lie. But I think, Ravi, you want to mention 1 or 2 things about how investors can use this table to maybe predict where they think the returns can be.
Yes, I love the sensitivity analysis, because it allows investors to decide based on how conservative they are where the exit cap rate should be. So we come up with what we think would be an appropriate exit cap for this particular asset. We highlighted that at 5.5%. But if you think that the market's not going to do well in 5 years, and you're looking more towards 6%, you can see what your returns would be. Versus if you think the market's going to do even better than we are predicting, then you can look at the lower cap rates and see where you are there. So it gives you the flexibility to choose where you think the deal will end up at the end.
So one of the things we've noticed is, as Judah was mentioning, there's leasing momentum. So the average effective rate is 15.74 right now. That's the cumulative rate between the 1, 2, and 3 bedrooms. And this is at 96.3% occupancy in June. What we've noticed is the last 60 leases actually are close to $1,600. So what that means is there's already a $25 bump organically that we're seeing from loss to lease. And so that's already a very positive sign for new ownership.
And I wouldn't be surprised if that was actually greater, given the way the sellers and having that active wait list. There's a good chance that they're even more under market than even that $25 amount.
And all the assets we own, I mean, this is one of the most, I guess, attractive looking assets we've ever picked up. So I really think I can understand why there's a strong pent up demand for assets like this. It is really well maintained. I think the ownership is going to be very useful for us to really focus on operations on the first half of our tenure, and then the second half really will be that second tier value add. And bonus depreciation is very important. It is one of the reasons why people invest in real estate. And as we know, in 2023, right now, we have an 80% top line level of bonus depreciation we can achieve. And so we are planning to do a cost segregation upon closing of this deal, which we're going to try to maximize those returns. And so once we find out that number, we'll share that with our investors of what bonus depreciation that they can participate in. Now, in terms of debt financing, Judah is going to go through some of the numbers and also maybe highlight the term that's still left on this fixed rate deal.
Yeah, absolutely. So this was a 10-year loan with about 7 years left. We have another 1.5 years of interest-only payments, which again always helps to kind of really jumpstart the business plan we put in place upon takeover. And blended with the supplemental loan that we anticipate being able to get, we actually already spoke to the lender who put in the Freddie Mac loan in place now. We expect to be all in just over $23 million of financing. And now again, over the last few years, debt service coverage has really restricted the amount you can borrow, whereas loan to value is kind of a pipe dream. Here, given the amount that we were able to get this under contract for by way of acquisition price, kind of as Rob mentioned, wasn't even the highest price being offered there. This comes out to about 70% loan to value. A number that really see at 70 or low 70s is what we really see as kind of being the optimal leverage. So we're very happy to have about 70% financing. All in will be close to 4% on our rate.
We mentioned the two-tier value-add business strategy. Tier one is operational efficiency, is really recapturing a lot of the fees that we should be getting for all the services we're providing. Phase two is really the $4,000 per unit renovation that will include specifically the tech packages, kitchen backsplashes, new light fixtures, smart thermostats, and that will allow us to bolster Park 33's best-in-class status. The interesting thing is a lot of times when we do value adds, we only do it on some of the units because of how this whole deal is structured and the capital reserves we have in place and the strategic way we plan to use them. We're going to be able to do this on the 100% of this asset, and that will really, take it to that next level. So in terms of financial analysis, in year one, our pro forma is close to $2 million per year, and through these capturing loss to lease, through raising rents to market, through using the operational efficiencies, and finally doing the capital expenditure phase two value add, we're able to add $650,000 to the NOI over the 5 years of ownership. This may not mean significance to many investors, but for people who understand multifamily and how it works, when you take the NOI increase and you divide it by the cap rate, you can understand the value creation that can happen to the bottom line of the value of the asset. And so that $650K divided by either a 5 cap or even a 5.5 cap, it can be between $12.5 to $13 million of value that goes to the value of the property. In terms of property description, based on T3 numbers and T12 expenses, we're buying this at a 6 cap, which again is highly unusual in the United States to buy an A-class property of this caliber. We talked about the debt already. We talked about how there's very minimal nearby competition. There's also a shortage within this submarket of 4,500 units that are needed by 2030. So over the next 5 to 7 years, which is the time of our ownership, there's going to be no supply, and increasing demand. And so we know overall in other markets we've seen, what that does is it drives rents in an upward trajectory. Because of the high quality of the asset, there's little deferred maintenance. So our expenses are minimal as we maintain this property. And we always want to buy in places where there's tremendous amount of employment drivers. And we find that here. First, the South Bend MSA has numerous industries that are humming along. Number two, it's near Chicago, where there's a lot of back and forth between the two major city hubs. And obviously, it's also close to Indianapolis. The community amenities, 24-hour fitness center with Peloton bike, a playground, attached car garages, resort-style swimming pool, the clubhouse, business center with internet cafe, poolside kitchen, outdoor kitchen, dog park. Here's an aerial view. Here's some of the amenities we've just mentioned. Again, washer and dryers in units are very attractive. Executives, corporate rentals, nurses, a lot of these people are interested in staying at our properties. And when Ravi was on site doing due diligence, he came back with some of the tenant profile, and he'll share with some of his findings.
Yes, yeah. So I spoke with the property manager on site, doing our standard tours, and we noticed many professionals, a lot of medical people. There are actually several physicians that live on site because there's a beautiful Goshen hospital that's been newly renovated, and it's driving more and more patients to that area. There are nurses, there are other people in the manufacturing hub that live there. A lot of young professionals live there. So a very wide, diverse tenant background, but in types of careers that we really look for when we want to acquire a property. And then also something we typically do, it's sort of for fun, but it gives us some information, is look at the mailboxes and look at the car profile, because tenants that take care of the property, take care of their mailboxes, take care of their cars, And it gives you an idea of the types of tenants that are there. And what we noticed was there was a great car profile, really nice cars and well maintained, and the mailboxes were well maintained. And again, that speaks for the property maintenance staff there, but it also speaks to the quality of the tenants as well.
And we're going to show you in a later slide. We did a heat map where we showed income levels and locations around our property. And there are several, income levels where it's $100,000 plus within a 5 square mile radius of this asset. Here's the modern fitness center, the dog park, the playgrounds, the unit mix, the outdoor grills, outdoor kitchen, the pergolas. We have a lake on the property. And so let's get to the rent comparisons now. So when we looked at rent comparisons, what the interesting thing is we found is when you look at the 1 bedrooms, it's a lot closer among all the different assets surrounding us. But as you move to the 2 and the 3 bedrooms, that's where there's a huge gap that we can capture here. I mean, $516 between some of the top level rents, close to $800 for some of the 3 bedroom rents. Now, we're conservative in our analysis, so we don't use these extremes in our underwriting, but you can see here the economic potential of what's possible. In terms of, for folks who don't familiar with the South Bend MSA, it is won numerous awards: best city for families, innovation hub, cost of doing business, hottest real estate markets, a diversified economy, leisure, hospitality, medical, government, manufacturing, tech, IT. And as a case study, this is a picture, original picture, as we renovated this extensively, but our original picture of one of our assets, Elevate on Main, which is a 400 unit, $76 million asset that we purchased, that was 2000 vintage in 2021. And through our Viking Capital asset management program and our partnership with our property management company, First Communities, we executed a very robust value add strategy. And in the spite of recessions and downturns and everything, our asset has increased in value by almost 10 million in 24 months. And that gives us a lot of excitement and a lot of reassurance that this is the right submarket to invest in. And number 2, we have the right team in place. And number 3, if we swiftly execute our business plan, we can achieve the kind of results that we pro forma out.
I mean, that property really shows our conservative underwriting in this market, right? We sat on this webinar, right? The 3 of us 2 years ago saying, listen, we think we can get $225 premiums. You and I, we thought we can get more, but we decided to be conservative, and we're seeing $350 premiums for the work we're doing there. So excited to get another one in the market.
Yeah. And when I was touring this asset, I also went back to South Bend and checked it out. And I was so pleased with the staff on site and how they're performing. And with the great thing about this is the property manager is also going to help us manage Park 33. So we're going to take the expertise and all what we've learned in that Elevate on the Main South Bend property and use that to our advantage in operating Park 33.
Yeah. So we've vetted the construction teams, we've vetted the the maintenance team, the leasing team. So all of that can be, there's an economy of scale and synergy between the 2 assets. Now, guys, I'm excited because, Notre Dame is one of the most well-respected universities out there. I watched Rudy the other day with my kids, so they were excited about it. But it's cool that institutions like this, like Indiana Tech, Purdue University, Indiana University, are all surrounding our asset. And so 35 college universities are within a short driving distance. And as my computer loads here, it usually bodes well when you have a ton of high educational facilities near asset. That being said, there's other demographics I'd like to highlight. The average household income within a 5 square mile radius is close to $80,000. 50% of the white collar jobs are a white collar, and a lot of renters in the area, 30%. Here's an aerial view of the asset. Now you can see it in its entirety. You can see the pool. You can see the complete separate buildings. It is very distinctive. It's very attractive, and I think there's actually high cost homes that are nearby as well when you're driving around.
Yeah. So if you look at this graphic towards the backside, there's a community there. Really nice, high quality homes that are right there, directly adjacent to the property, and they're very well maintained and very high class. And you can see also in there's a new hotel that's also adjacent to the property. There's also a really nice park, a lake where tenants can, and the various people can walk around the lake and go boating, go fishing. So it's in a really nice location.
This is close proximity to a lot of other business centers. Chicago, MSA is right there. We have Indianapolis, we got Fort Wayne, we have Toledo, and we have Detroit, all within a short driving distance. And it is also going to benefit from North Indiana's business culture. So there's a surge of infrastructure being built here and overall low competition. And so it's become a very business friendly state. Tremendous number of employers here that you can see highlighted. One of the biggest employers is the RV industry. It is considered the RV capital of the world. And 80% of the world's recreational vehicles are built, constructed, and sold here in this Northern Indiana, South Bend MSA. And you may be wondering, hey, why is that important? Well, we look at a lot of different economic drivers. And so even if this RV industry wasn't there, this would be an amazing place to invest. But because of the RV industry, it's even more attractive. It's $114 billion of economic impact. There's $20 billion of RV sales per year. It's increased 17% since 2018. It provides 500,000 jobs. There's 30,000 RV businesses that are based off of the RV industry, $32 billion of wages. So it really, the outdoor recreation itself, which RV plays a huge role, is 2.2% of the US GDP. So it is a big deal. And the cool thing is, yes, they are an industry dominated by RVs, but they do other kind of manufacturing. And so during the last 2008 cycle, they learned their lesson. And so they've diversified. So even if the RV industry has a slowdown, they're manufacturing other kind of automotive parts and other kind of parts, which is really cool. This is other reasons why there's catalyst for a lot of Indiana growth. There's tremendous amount of capital coming to Indiana from private equity, from startups, from incubators, from medical, from tech. There's low business taxes. There's a 250% increase in job. There's a high bond rating, limited housing, and there's a lot of industrial development. Here's other accolades that we can see. It's a startup incubator as well. South Bend, in terms of employment, we mentioned healthcare. We always like to go where there's healthcare, like we call it med and ed. Medicine and education are safe sectors. And so when we see a lot of that, we know that there's a stable tenant profile. On top of that, we're seeing high-tech manufacturing. We're seeing biotech, logistics. So all of this is very attractive for us. Now, as we wrap up here, and we're talking about Viking and why our investors should feel comfortable investing with us. Well, we have a significant portfolio already. We have a machinery in place to really execute on our acquisitions, and a lot of these assets have gained value over the years, and our exits and performance sort of speak for themselves. Over the last 3 to 5 years, we've exited 2,000 units. We've averaged a 24% annual return to our investors, and we're really in it for the long run. We're here to build a company that is very investor-centric and focused on helping our investors achieve their financial goals. As a case study, this is our property in Indiana, Elevate on Main, and it is doing quite well as we've done a tremendous value add on this project, and we've achieved $225 monthly rent increases during our ownership. These are the two properties we recently purchased, Elevate Green and Elevate Eagles Landing. You may know them as Crossings at McDonough and Crossings at Eagles Landing. And they are doing quite well. Investors are really excited about all the monthly rents they're achieving here. And we're on track to executing our business plan on these two current assets that we recently acquired. And with that said, guys, we're going to get into a little bit of Q&A. But if you're ready, if you're excited, you're pumped up, here's a QR code. This will allow you to get and bypass a lot of the other folks and get into our investment circle for the Park 33 asset. And you can, go ahead and put in your reserve and get your process started to invest. If you have questions, you can consider emailing us at invest@vikingcapllc.com. Also in the chat box below, my investor relations team will be putting in contact information as well as booking links. so you can get on the phone with them, learn more about the asset, get your questions answered, and see if this asset makes a lot of sense for you and your investment thesis. So guys, any last words before we unleash on the Q&A?
Yeah, sure. I'll just mention one more thing. You know, investing in Park 33 now has the benefit of this being our second Indiana deal. When we bought Elevate on Main, we still had to, you know, get fully comfortable with the tax program, the tax system, which is very unique in Indiana. And now you can invest in us after we've now gotten to know and had many conversations with the tax assessors. We had to go out and find local vendors, find, you know, who can come work on our site, find the right management team. We now have all that in place. And it's really an opportunity for us to hit the ground running with this kind of lower risk Park 33 asset. So yeah, come join us.
Yeah, I'm excited, guys. Come join us. It'll be a fun project to be part of. And I think it's going to be very lucrative. And I really think we've done a conservative deep dive into it in terms of the due diligence, in terms of structuring it where it can sustain no matter what happens in the economy. And I really feel very bullish on this asset.
Yeah, I'll just add a couple of words here. Just want to thank all of you for listening. Those of you that made it through the entire webinar, really appreciate your attention. And once again, we're always happy to answer any questions you may have. You know, there's some people are fearful in times potentially of a recession, but remember, be greedy when others are fearful, be fearful when others are greedy. So we're in a time where this asset is performing well already. It's got low interest rate, fixed debt. We're seeing rents increase steadily over time. I'm very excited and bullish about this particular asset, and really hope that you can get involved in it.
All right. Thanks, Judah. Can you press the button there?